Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Shafiq Taymuree from Stonecrest Financial, a private mortgage fund based in San Jose. They offer two unique loan programs for homeowners, real estate investors, and business owners throughout California. We talked about their lending activity the past 12 months, trends that they're seeing, predictions for 2026, company history, their capital source, and we spent a bunch of time talking about their two loan programs and specific guidelines. I hope you find this episode to be insightful. Here's my interview with Shafiq Taymuree. All right, Shafiq, thank you for joining me for this episode of Private Lending Insights. How's everything at Stonecrest starting out for the year?
Pretty good, Rocky. Thanks for having me. We've gotten off to a good start, and hopefully I'll continue.
Excellent. Let's first talk about your lending activity from the data I have with Forecasa and Elementix. It shows that you've funded in the last 12 months about 200 loans and almost $300 million in total origination volume. Does that sound about right?
Yeah, it was a good year, minus a slowdown that we had in part of the year, which was surprising. We had a little bit of a lull, and kind of towards the end of summer, beginning of the quarter, which came early, and it just was kind of a little bit more eerie quiet. And so we were concerned with some of those things, but it seemed like people were sidelined with interest rate changes and seeing where they were going to go. So it picked back up, and we had a bigger December, and our purchase market money larger than we've had the prior year. So, but overall, when you average it out, we had a pretty good year, solid.
And it seems like from 2025, the Q1 and Q2 numbers were a lot more. So you're saying it's because interest rate changes or the anticipation of lower rates?
Yeah, it felt like it was a shift to a buyer's market, which I think did happen to a certain extent. It just didn't take hold to as long and as much as it could have. When interest rates dropped back down, I think at the end of the year, it got people off the sidelines, and they started to have a little bit more confidence to, get back into the market. Hence, people buying and doing activity in December, which historically is a low, where we ended up having a lot more purchase money transactions.
And Stonecrest Financial only lends in California. And just to clarify that for our audience, what are some of the loan types that you fund, and what's the breakdown of percentage as what are you doing the most of and the least of?
Sure, yeah. So we do only lend in California currently. Some of our featured products, I think two are the main drivers. One is our consumer primary bridge loan. And so we have a pretty good volume of business that happens there. It may never be a high percentage of what we hold in our fund because they churn and they pay off relatively quickly. So depending on what time of the year you're taking a snapshot, that could be a larger percentage or smaller. But from a funding perspective, it's definitely one of our heavy volume transactions that we put through the system. Our other product that is what I call more sticky, that stays in the portfolio, makes up the ones that stick around, is our line of credit. We have a line of credit product that's truly revolving, that goes, up to 5 million, can be expanded to 10 million on exception. And that product has become very popular because they don't pay any interest on what they don't use, and similar to those, that they're not a one-way draw. So that product makes up probably more than half of the portfolio at a snapshot of if you take the portfolio generally.
And what about standard bridge loans where it's just a standard refi, a standard purchase with no line of credit, and it's only for investment properties? Is that part of the loan portfolio over the past year?
It is. It's a little bit different capacity than what typical bridges that you are seeing with fix and flip lenders that are looking at the bridge. We have more purchase money, investment purchase, and then also a variation of that is a reverse 1031 exchange that we do. That's again feels more like our residential consumer bridge, but it's set up for reverse 1031 exchanges. And then we have our normal refis, but that really gets captured in our line of credit. Most people opt for that product, but every once in a while we get a straight out loan refi that's somebody has a need.
Okay. We'll get into the specific guidelines for each of these programs shortly, but first I wanted to ask you about your expectation for 2026. Do you think that the loan products that you're offering, as far as the breakdown goes, is going to be similar in 2026 compared to 2025?
You know, I'm cautiously optimistic for 2026 just because there's so much happening with the environment, right? The things we don't control is how all of a sudden we have war or we have things that impact and oil prices and that can either affect rates positively or negatively. I think there is a direct tie now versus the heated markets of where interest rates go. I mean, not too long ago, the 30-year fell below 6 for the first time in a long time, and those type of things are going to spur on activity. And what's been interesting is pockets are still low inventory and moving quickly. Other pockets are sitting on the market and not moving, depending on, the different places in California. So it's going to depend on some things, but the start of 2026 has me cautiously optimistic because the volume is January was bigger than last year's January. Then we had a little bit of a pause just for about a week, but then it picked right back up with activity. Our biggest kind of canary in the coal mine, so to speak, is our purchase money bridge loans because that's spread out throughout California with a lot of agents. We have a wholesale channel, so that really gives us a good feel for what activity is happening, at least in the residential market. In the commercial market, which we also play in, it's a little bit harder to really gauge. It's capital needed if people are expanding or they feeling, and that could be a positive or a negative, right? Because people need capital for both reasons. Either their business is booming and they need some capital quickly before they go and become bankable for what they are looking for. Or it could be that they're coming to us for distress situations, which is not something we like as much because business is struggling or, feeling a downturn. So those we kind of judge on, what's being said and what's the request for, right? And then you start seeing a trend line of everybody needing bailout money, and you're concerned. If you're seeing people with expansion, then you're a little bit more interested in that side. But 2026, as of now, feels like it's going in a positive direction. We're continuing to expand ourselves and expand our footprint, especially in our wholesale division. So that in itself could create more volume just from having a wider net.
And tell us about defaults, foreclosures. Is that have you seen an uptick in that in 2025 versus previous years?
We have just from a uh, being involved in the industry, like in California Mortgage Association, made a lot of friends, and we have some others that we talk, and it seems like it was across the board where they had an uptick. We've been fortunate that several of our product lines have, like our consumer bridge loans, have had zero defaults since we started, and they continue to be that way because those underwrites are just different and the product line is different. But the ones that, less than 3% of the portfolio that historically has seen it, we were at super low, no defaults, obviously, a few years back. And, actually, before COVID, it was hardly any because it was such wind behind everybody's sails. Post COVID, we had, a handful that we had a deal, and that was a long drawn process to get those to kind of the finish line. New defaults did uptick a little bit in 2025 for sure. Not as much as I've heard across the board with others. And I think this is our product, not necessarily the market. I think the market is an uptick in 2025 from everything I've heard.
Okay. Let's now get into some of the specifics of the loan program. Since you talked about the consumer bridge loan, this is basically a buy before you sell situation where it's a homeowner that has equity in their existing residence. They want to go out and buy a new home and use equity in in the previous home to purchase the new home. So tell us exactly how that works and how the numbers shake out.
Yeah. So it's pretty straightforward. We can finance up to 100% of the purchase price. And that, our loan amounts go to 5, again, on exception to 10. We're going to be a first on the purchase. And as long as there's enough equity, we can go up to 100% of the purchase price. But if it's not, then they will have to come in with some down payment. And we'll be cross-collateralized on the departing to swing the equity over there. We could be in first position on the departing, a second, or a third if they already have a first and second on there. As long as there's enough equity to kind of meet our combined loan to value of 65%. Um, Most of these people, a lot of them have really good credit. They may have a bunch of reserves, but they may be tied in the stock market. They don't want to get capital gains, or they don't want to liquidate assets. So exactly what you said. They're trying to swing their equity, do their purchase, pay it down when they sell their departing, or pay it off. And once they pay it down, then they get their refinance and get their permanent financing. And that's usually a 6-month loan, can go to 11 months. So that's the typical program that we have there.
And people listening to this from other states may be confused that, private lending across the board, across the country is not for consumer purposes, but this is a unique program that's common in California, and maybe Arizona is one other state that I've seen this taking place a lot. Tell us about what makes it possible for the state of California to do these types of loans and private lending.
Well, it's twofold. The main driver has been is that California market gets heated up at various times, where you can now make a contingent offer, where maybe other states that's more common, where people can say, hey, I'll buy your house as soon as mine sells, right? And make that contingent on their selling before they buy on theirs. And that happens more in buyer's market. Inventory has been historically super low in California for majority of the main markets. So most people are opting, and because of all the, I believe, high-tech business and people, you're competing with a lot of cash offers and people who can act without contingencies and things like that. So they needed a product like this. Where California is unique is also it has regulations and laws that allow short-term loans to be exempt from certain requirements that other loans that are longer than that 12-month period have to abide by. Because in the downturn, we had new laws passed that's across the nation. It was called Dodd-Frank. And a lot of restrictions went into what type of loans you can do and what you can charge. And if you wanted to participate in those type of mortgages, the exemptions that were written across the federal, and then you have to also reconcile that with your state. And our state allows certain exemptions for people wanting to swing their equity. And it has to be a true bridge. It just can't be a short-term loan as some people understand it. But if you are actually utilizing the equity in your departing property to get this, and it's less than 12 months, then you have certain exemptions, but you have a lot of other requirements that you have to fulfill.
And so this is a common loan offered by private lenders, and so the consumer mortgage lenders are not able to offer this just because of the nature of it being short term. Is that right?
Correct, yeah, and they're not in the business of doing what you fall under a higher cost mortgage, and you have certain exemptions, but you have others, and most banks and bank type of lenders lose money unless your loan stays with them for a period of time. Generally, it's like a 2.5 year to 3 year break even, depending on what kind of pricing you pick. So they get their servicing and then recoup, and they're really banking on the fact that you're going to stay in it for their average of 5 to 7 years is what they calculate, right? So coming in and out, same thing with our reverse mortgages, 1031 reverse. Nobody's interested in doing a 6-month loan because they lose money on it. And the cost and all the other regulatories is not something that a regulated bank wants to deal with. So that falls into private money.
The structure of the loan is that you've got collateral, or you've got a lien on both properties, and then hopefully once the borrower moves in to their new home, they put the departing home on the market and it sells within 6 months, maybe a year. And from what you said, there's hardly any default with these types of loans because the home always sells within the 12-month period. Is that correct?
Yeah, if you underwrite it correctly. So there are people who do bridge loans without taking the consideration on the exit. We're very cautious to look at, hey, if the house doesn't sell for what they expected or the timing, did they have the wherewithal to, come up with some cash difference if it's not enough proceeds coming out of their home? We've had a couple of people where things they unexpectedly came. We always give them a grace period for this because majority of people take a 6 month with us in this markets that we lend on. If they're in some areas where the market is slower, then they will take the 11-month option that we have. So it's lender by lender, and for us, we've just been very strict that if we don't think their exit is clear or they're so tight that if their house sells for 50,000 less, they're stuck. That's really what we're looking at on our bridge loans is, how viable is the exit and can the client really manage this type of expense?
And give us some guidance on the leverage. Let's say you're underwriting one of these deals. How do you structure the loan to value? Maybe give us an example throughout some random numbers.
Yeah, yeah, of course. So if you have somebody has a departing property that's worth $2 million and they have 500,000 owing against it. They're buying something, they're planning on downsizing, they buy for like $1 million. So now you have between the departing at 2 million and you have the new purchase at 1 million, you have 3 million in an overall value because you're collateralizing both. You have $1 million loan for the purchase plus the 500. So you have a total debt of 1.5 million. You're at 50% loan to value. So that's how the calculation is done. You're taking the senior lien in consideration that's ahead of you. So you take total debt against total value, and then that's your combined loan to value. After that, it really well, not after that, but the max is 65. We have made exception 5% at our discretion, depending on their exit, their qualifications, all of those things. We used to be at 70 to 75 on exception, and it was a different market that changed a while back. So that's kind of where we sit on those.
So 65% is the total combined loan to value.
And one other unique thing they can do since we're already crossing, if they have another property, let's say they have a rental that they own for 600,000 that's free and clear, and they bump up, we'll take a third property as long as we think the exit is clear and they don't have to deal with, having to come up with cash still.
Excellent. And just to clarify, both homes have to be located within California, right?
The one that has to be in California is the departure property. We've had some scenarios where somebody owned their home in California with tons of equity, and as long as they don't have more than one lien against it, because we won't go on a standalone third. So, or they can pay off their second with their own resources, not from our loan. But let's just make it simple example. They own their home free and clear in California for 3 million, and now they're going to buy in Texas for 1.5 million. We can give them the 1.5 million. We document the contract for the purchase in Texas, whether it's an escrow or an attorney's office, whoever's handling the closing has to be given to us. All net proceeds from our loan has to go directly to that escrow. And so that we call our out-of-state purchase, but it doesn't work the other way around. And so if they're parting in Texas, they can't bridge with us into California because it would just be a purchase money consumer loan at that point and not a bridge if we don't tie it to departing property in.
And in that scenario where they're buying a home in Texas, are you putting a lien on the Texas property? No. So
No, that's why we control where the money goes to identify that it is for a purchase of a new primary resident to continue to keep the exemption, but we're essentially 50% loan to value on the California, and we don't have any additional collateral.
So in that case, when it's out of state, there has to be so much equity in the departing home that
Right.
essentially whatever your 65% loan to value is would completely pay for the purchase of the new home.
Yes.
Got it.
Absolutely.
Okay, excellent. And are there restrictions on what state that they can buy in? Nope. Okay. So it could be Nevada. The licensing requirements don't apply because
Correct.
you're not putting
I'm
a
not
mortgage
touching
for.
those properties. All I want is their escrow so that the money never touches the client's hands, which would make it a cash out refi consumer loan that would
Mhm.
not fall into the guidelines.
Got it. And so the loan amount would be the exact purchase price of the new home.
That's the
Uh,
max. They could put some
Correct.
cash and take less, but they can never take more than the purchase price. That's why we want the contract and the escrow to make sure one of the requirements for these loans is never finance the closing cost, points and fees cannot be financed because of the nature of the interest rate and the term. The APR jumps high because of the short-term loan. And so you have to make sure it's considered a high cost mortgage that you don't finance any of them. So you never are financing points and fees if you hit the max as the purchase price.
Okay. And since you brought it up, let's talk about the interest rate and the fees associated with these loans.
Sure. So our rates right now just came down a 0.5% to 9.95. And typically it's 2 points for 6 months, 2.5 points for 11 months.
Got it. So the cost of doing this bridge loan is just around 10% for the interest rate plus the 2 points or 2.5 points. But the interest rate is only paid obviously for for the time period that they have the loan. Is there a prepayment penalty on?
No, there's no prepay. They just can't have their departing property listed because we need to have enough time to at least board the loan and generate the payoff. So we ran into that at the hot market where we got a bridge loan, and within a week before we could even board the loan, there was a payoff or pay down request. So we've not had them dual track, and they have to list the property after they close with our bridge loan. And yeah, um, they're interest only. Typically, you know, they pay it down, then the payment can be adjusted during that time if they need it. One other option that I should mention, since you brought that up, is that we also have for a 0.25% higher in the interest rate, deferred payments, where the payments just accrue. So somebody doesn't want that big payment shock on a $4 million bridge loan they take with us. They can, if they have enough equity and they're below 60%, then we will give them that option to go to a higher rate, defer it, and then it gets paid out. All the payments get paid at the time of closing.
Excellent. So if they want to not have to make any payments during the loan term, they just pay an extra quarter point. So that's and a quarter
Quarter
point,
percent on the interest rate. Yeah.
a quarter percent. Okay, got it. So
Yeah.
so
So you'll
instead
be
of
10.2 instead of 9.95.
got it. Okay, so it doesn't affect the origination fee.
No,
It's just the interest rate.
just the
Okay.
interest rate because there's a carrying cost for us because that money doesn't come for us to lend back out. So
Okay. Excellent. Uh, okay, and then if someone has enough equity in the home, the numbers make sense, they're okay with the pricing. What are the other qualifications? What about credit score? Is that a factor in these loans?
So I always answer these yes and no. So let's say they had a free and clear home and they're downsizing and they take $1 million loan against their 2 million home. And once it sells, they're out. There's zero requirement because the exit is clear. If they're let's moving over and they have to qualify for $1 million takeout loan after they sell their departing, then the credit and income and reserves, all that comes into play because of the exit. They have to qualify for the loan they say they're going to take ultimately. So in that factor, absolutely, it matters. It's really, these are all underwritten to the exit. So if they have 400 credit scores and they don't need a loan after they sell their departing, it makes no difference. There's no requirement for that.
Okay. And do you need to see any sort of pre-approval that they would qualify, or is that something you can just underwrite on your own?
It depends when it comes to our retail channel or our wholesale. So wholesale channel always provides a pre-approval and through their underwriting system and gives us an idea. But that doesn't stop us because we have a complete file to make sure that that makes sense. There are times where we've received a pre-approval and we've had to question like, okay, I don't see income enough for this type of loan, or I don't see enough assets. And how are you approving these? And they may have a good answer or maybe a turn down at that point. So it has to, we've done lending for so long that we know generally. And then if it comes through our retail channel, we run it and to make sure that they qualify and get all the backup documentation to make sure we're not setting them up for failure.
Okay. And since you mentioned it, tell us about this wholesale division. What is this for and how does it work?
We just historically set up partnerships. People wanted to utilize our product. These are lenders that sit in a lot of the real estate offices, and over time, it's just become popular, and loan agents move, and they've demanded that this product be available at their new company for them to go over as they got pushed by another company. And it's just taken on its own growth, and it's been great. They get a 1-2 punch, so to speak. They get the paid on the bridge loan, which we share in our points, so that the borrower doesn't have to pay more. That's what makes it wholesale. But they also get first crack at the takeout loan after their property sells, and it gets them to be more of a hero to their realtors that they're trying to capture as the in-house lenders or their contacts, whatever way they're doing their business. So we have several large companies and then a bunch of other ones that are maybe mid-size mortgage bankers primarily that have these things, and probably over 1,200, I think, loan agents that have our product, access to this product and purchase money. But we won't do any refis or anything, cash out or line of credit through our wholesale channel. It's strictly just purchase money. Primarily the bridge loan that's piqued their interest and has become a good tool in their tool belt.
Interesting. Love it. Okay, now let's move over to the other loan type since you mentioned it. If it's not a consumer loan, the primary residence bridge, let's talk about investment property loans. Tell us about this line of credit product and how it works and what types of scenarios you use it in.
Yeah, so the line of credit's not really restricted to the investment purchase. So investment purchase money is anybody that needs the short-term capital. Either they're buying something and they want the acquisition money, will go up to 70%. 65 is preferred, but purchase money always has more weight. And so we're generally can expand to 70 pretty comfortably if everything else makes sense on it. Or they, like I said, they're buying it in a reverse 1031, or they're buying a commercial building and they need to get it stabilized or move in, and they need more financials before they take an SBA loan. So because we don't just play in the residential market, I think I see more on the commercial side, as people a lot of times have a lot of contacts for these bridge financing for the fix and flip guys. That's not really where we do a ton, but the line of credit is something that they look for those investors that are buying property, if they have a stable portfolio of properties, and that could be mixed between commercial, residential, apartments, whatever it is, because we can underwrite all of those and use multiple properties. We can get them pretty substantial line of credit. Sometimes we've used up to 8 different properties in all different classes to achieve someone getting a $5 million line of credit. They love the flexibility. They can go and actually act like an all cash buyer. They can buy something and not deal with the construction draws and the inspection and money in reserve. They can use their line just to fund the deal till they sell it and then pay it back down. But that's just on the real estate side. Then you have entrepreneurs, business owners. They may be manufacturing plastics here, and they have a warehouse, and they have a nice low interest rate SBA loan, and they have tons of equity in their warehouse. We'll give them a line of credit in second, as long as it makes sense. We're not going to do a small line against a huge ass first. I'm sorry, excuse my language. A large,
That's okay.
large first. But if it makes sense, let's say they have a $400,000 or $500,000 SBA loan, and they have a $2 million warehouse, and they need 500,000 because their business is expanding and they can't go to the bank yet, and factoring costs too much. They love our line of credit. They put it in second position. They'll fund all their purchase orders or buy equipment, whatever they need. And as they receive, they pay it back down. Just like people use their bank business line of credits for those who have established enough history and can get those. So that's another, possible use. We could go down to the nitty gritty of like fiduciaries trying to manage an estate, right? Of a client, they're real estate rich but cash poor, and they need to handle things. They'll get a line of credit from us. So that's just a few samplings that we've seen, from the uncommon ones to the most common uses that we've come across for those.
And let's talk about property types. So just to clarify, this can be used by an owner-occupied home, but as long as it's for business purpose only.
Right. Now that's going to be scrutinized with us pretty heavily. It's not like you just come in and say, "Hey, and I say this, and everyone's going to laugh, but this was an actual scenario. Um, I'm starting a beef jerky company in my garage when they had properties in foreclosure and defaulted on taxes that were going to sale. But here's the business purpose part of it. I'm starting a beef jerky company inside my garage." So that's an extreme example, but we'll vet it pretty hard if it's touching the owner occupied. We don't want to just take it at face value that it's business purpose. It really has to meet a lot of requirements. It's a lot easier if they have a commercial building, they have a business entity that's established and it's borrowing against that. Now we have used the owner occupied as cross collateralization. That makes it easier as well. They have a clear business, they have a business real estate and all those things, but they need more equity and they have equity in their home, and that makes them get a large enough line, and we feel comfortable we'll cross the owner occupied.
Okay. And so it could be first or second position, prefer commercial property. Are there any specific property types that you won't consider?
We're not doing much in the way of land. We definitely won't do anything that needs future value. And the trickiest part is where you have people that come to us with valuations of saying, "Hey, yes, I have this warehouse that's sitting here, but the entitlements that I'm going to have on it and the development play will make it worth X, right? Or it's worth X because I got it already into this." We're not interested in that. We will take it at and look at it as is, as a warehouse today in a trade, and people get very shocked at the difference between that value and what their potential value is if everything goes right with actually getting it developed or selling it to a developer. So we're pretty conservative on that side of things. Special purpose properties, obviously, we don't stay away from them, but they get a lot of scrutiny. Special purpose combined with very rural outskirt areas, it's probably going to be a no-go.
How about a hotel?
Hotels are fine. We've done them, but it's again case by case. Everything in the commercial, I should almost say it's almost case by case because it just has so many nuances to it and the underwrite in terms of what market are you in? Is it owner user? Is it investment? What kind of cash flow it has? And, its assets value. But we'll look at pretty much anything and get a pretty good feel um, whether that makes sense or not and where we want to value it.
And what are some of the unique property types that you've lent on?
There's been some hotels that's converted to assisted care facility. Some unique things have come about because we've had the opportunity to cross standard type of properties that allowed us to do it. And we did a music venue in San Francisco. Obviously, that hasn't gone well for the borrower, unfortunately, but we have three other good cash flowing apartments that now is going to have to be, with us. So maybe the most complex ones as when they're on land lease and needing to make sure that there's enough, you know, time left on the land lease. How do you evaluate those? And um, I actually, speaking of that, that one that's not sitting on land, it's on a wharf uh, on piers. So but we were able to, it's a restaurant in Monterey or somewhere in that area. That was kind of unique in its sense. But everything else is pretty much, we've done gas stations. We don't like gas stations. We've done, various things, but it always has to have some kind of mitigating factor that compels us to look at those things.
So you can look at a real estate investor's portfolio, and if you're not so comfortable with the primary asset, you can take a second position or whatever's needed on other collateral.
Right.
Okay.
Yeah.
Great. And so these line of credit loans, they're typically essentially a cash out loan, right? But they don't need all the cash up front at one time. What's the typical term for these loans?
So we have a 1 year, 2 and a 3 year, and the rate and fees go up commensurate to that. So your 1 year is going to be somewhere close to, depending if it's a first, it's going to be a 10, 10 and a, 10 and a half, 11. You get into second position, you're probably closer to 11, 11 and a half to getting to 12. You're typically 2 to 3 points. So 2, 2.5, 3, depending on the term, for those. And then sometimes we have brokers participate, so we'll keep our points to a 2 to allow them to charge without it getting too crazy for the borrowers.
Okay, great. And so let's say if someone has a 3-year term, they're using this line of credit cash out. Let's say they cash out, the loan amount's 500,000. They're drawing that whatever amount they need, they pay it off, and then they're back up to their maximum amount. So they're essentially just using it as a revolving line of credit for whatever business purpose they need, and they're only paying the interest on what they use. Okay, but the points is for the total loan term.
Correct. So if they take a 500, then we charge 2 points. It's 10 grand upfront for the credit limit. But they can keep literally a zero balance for the entire term. And I've had a client do that because they just wanted the peace of mind to have it available, and they paid no interest during the entire life of the loan. And there's no early closure fee. There's no minimum draw. There's no minimum interest charge. And that's the part that stands out, people like, and they can draw on it a couple of times a month. It's not meant to be like hundreds and hundreds of draws. There's a draw fee with each one, and we're not a huge bank. We need to have staff that continues to send them out their payments and manage that. So, but they can pay it down whenever they want, as many times as they want through our servicer.
Great. And what's the maximum loan amount for this line of credit loans?
So 5 million on exception can go up to 10.
Excellent. And what's the average? What do you see for most of the people using this loan product? What are they?
Loan size.
What's the average loan size? Correct.
Yeah, our wheelhouse is between that 1 million to 5 million. I venture that 80% of our lines sit somewhere between that, probably 500 to 3 million. But the sweet spot's going to average out probably around 1.5, 2.
Okay. And I don't know of any other private lending company in California that offers this. How is this possible? How is Stonecrest able to do these line of credit loans?
Well, from an early on, we got involved in this just because we were able to set up our own internal line of credit with our bank and have leverage available to have working capital and not sit on cash. That would drag our yield down. And two, we have a fund model that doesn't work for anybody who's selling individual trust deeds, or people have tried a couple of times and it's not the greatest idea. I can imagine if client has a draw request and they need their money, and your investor is in Bahamas on vacation for 2 weeks and not available, that would not go very well. So we've had our fund, and so we have and then we have a very tight cash flow management and cash reporting, everything that just developed over the last 16, 17 years. And it's just been a great product, but it just takes a lot of back end work to make sure you know your commitments and that you have what you need, so that you can always be funding whatever the clients need, and they're not kind of left. So part of it's the borrower's trust that you're around and you've been around, and your reputation out there. Because if somebody did a draw request and you weren't able to fund it, it would not be a very good situation. So that's kind of our, kind a special sauce. Get into too much details of it there as far as the other pieces go, but um, all it, all in all, it has to do with having a large enough fund and having enough backing to make sure, and then having some additional outlets if you needed to generate capital to meet that. Outside of that, it's our servicers is also set up to manage these line of credit products, and they have the wherewithal and the communication that happens between our accounting team. I mean, so we have 4 in-house accountants inside of our shop. So gives you an idea. If you're a smaller shop, then that's going to take a lot of labor if you don't have enough resources to manage everything.
Sure, makes sense. Yeah, it's a great loan program, very unique, and I'm sure a lot of real estate investors can benefit from this, and business owners, of course. And so we talked a little bit about some of the requirements, but let's talk about the financial requirements for borrowers. How do you look at the credit score, and do you have any other requirements aside from the equity in the properties?
Yeah, it's not so much credit score driven as it is. I've had good credit scores, but I see someone completely stacked on their credit and they're looking for a business loan against their owner occupied, but you see that they're not making enough money. They're losing money in their business. They've been using their credit cards to live on. That really is a consumer loan and a bailout loan, and we're not interested, even if they have 720 credit scores. We're much more common sense in terms of looking at the whole picture and seeing what the different tells are. And that will give us a good comfort in terms of where we want to go. Somebody has really poor credit and there is a good explanation for it. And what they are trying to do totally makes sense. And they have enough equity and they have their exit plan isn't, I'm going to raise my credit score and refi, then sure. And give you an example of what that would look like. Son doesn't have great credit, inherited this building from the father. Realtor tells him you need to put 400,000 into it and you're going to make multiples there. It was neglected. There's no loans against it. He's going to fix it up. The broker's going to put it on the market, sell it. Likes to use the line because the project maybe takes 6 months, 7 months to complete with the contractor. Sure. No problem with the credit, right? Because there's equity and there's an exit. And it makes sense. So no longer is it something that I have to worry about, that person accomplishing. Same exact scenario. The guy's had, a building and he already has taken 2 other private money loans, wants to consolidate it, take some more cash, and has 500 some credit scores. And he says, I'm going to get my credit score up in 2 years and then I'm taking a bank loan. No, thank you. Heard that story way too many times and it never happens. And so that's kind of the credit score story, if I can put out there. It's not a score driven, it's really a story driven in common sense.
And do you ever have people who get a 3-year line of credit and then they want to renew, they want it for another 3 years?
I've had clients that probably with us for over 15 years with this product. They love it. But we will re-underwrite them every time. And so if they take it 3 years, they come back for renewal. If markets have shifted, which they recently did, or rates have shifted, then those things get adjusted. So either it's just an extension if certain things are going well and they provide us that they're doing well still, and they just pay an extension fee and then it just continues, which happened for a good while in the markets. Then there are other times where now we need to do modification because our rates have changed. Or hey, we need to re-underwrite this because collateral is no longer feel comfortable in this particular one being another 3-year outlook. And we need to either sometimes add additional collateral or reduce the line or get out. It could be any one of those things. But generally this is what we call our most sticky product.
And you mentioned earlier, fix and flip investors and builders also use your line of credit program. Tell us a scenario of how a person flipping houses would use it when there's all these lenders out there that offer your fix and flip loans with high leverage.
Yeah, so we have one that comes to mind is a big player that has a huge construction company. And has built up a nice portfolio of properties. And then now he's realized that he wants to continue to flip some of these higher end homes and really good high end markets. Well, that takes a lot of players that would, the loan types and the stuff they do. Once he needed our line of credit for putting up a bond for 3 million because he does these huge projects and he saw the benefit of it. He's just continued to take line of credit against every one of his properties that he's held just for the flexibility of it. And now he's been buying and making good money and it moves faster for him. So he just likes the quick access. And so he can email us within, if it's a larger request, within 5 business days, his money's there. And most of the time it's 24 hours. We say 5 business days just to make sure if we have, our internal, if someone's out or something like that. But 24 to 48 hours through our process, they have access to possibly their whole line, right? And so that he has, I think, outstanding like $7-8 million line with us and different properties. And so that's how he's used it and get some great deals. And he can give all cash offers to get a better price.
Excellent. So they have to have a bunch of other properties, or even at least one property with sufficient equity that secures the line of credit, equity cash, and then they can draw on that whenever they need. They don't have to go out and get a lender for each and every single loan and deal with draw inspections.
And sometimes they have a great contact or a avenue to take higher leverage at lower pricing on the. So I had a couple of those guys, and when it was really hot for fix and flip, they used our line, they'd acquire it and don't have any escrow, and everybody having an issue that, hey, you offered all cash and now there's loan docs, because that became a thing. They'd use our line, do the purchase, close it immediately, take the leverage from the bank loan or non-QM or fix and flip lender that's more aggressive, and recoup that cash, pay our line back down, and then fund their rehab with it or use it for the next buy. So they'd use it just for that fast flexibility of really truly acting like a cash buyer where money just goes into the escrow account from them. And they just took a draw from us and then pay it down as soon as they can. And they don't pay interest on the rest of it until they need it again.
Love it. Excellent. Well, let's go ahead and take a quick break and we'll be back in 1 minute. Support for this show comes from Forecasa, an amazing data platform for private lending and real estate investing. Private lenders, note buyers, capital providers, real estate investors use Forecasa in a variety of different ways. You can see which lenders have funded which loans. You could see which real estate investors have gotten funding or sold a property or purchased a property. You can see loan assignments to know where the loan was sold to after funding. Many people use Forecasa as a prospecting tool. I personally use it to vet lenders and for general market insights. It's become an essential part of our business, and I just wish I had access to it sooner. We publish some of Forecasa's data on privatelenderlink.com. When you do a search for lenders, you could see the top 20 lenders in each market, and we've also added the top real estate investors in each state and for some of the metro areas. Visit forecasa.com to schedule a demo, and please mention that you heard about them from LenderLink and the Private Lending Insights podcast. Okay, and we're back with Shafiq Taymuree from Stonecrest Financial. So let's talk a little bit about locations, the geography. What parts of California do you typically lend in? What parts of the state would you avoid? Tell us a little bit more about how you look at that.
Yeah, for us, it's product by product, right? And so our consumer bridge loans, we don't exclude any area. Where it gets impacted is if somebody has a departing property that we see there's not a lot of comps around and may take longer than what our bridge term is to move it, or its values and stuff like that. We don't run into that too much, honestly, but if we did, we'd have to take a look at it and from that perspective. Otherwise, all of California is open. It just, as long as the exit is not impacted within the term and what they want to do with us.
So you're talking about for the primary residence bridge loan where the home's going to be sold within 6 to 12 months. Uh, in that case, you're a bit more flexible on the location. It could be a little bit rural.
It can be as long as there's a market, right? If we see that, hey, there's nothing moving in these marketplaces, or that might be a long shot in terms of getting done in our time, and you're going to run out of time and money and paying this higher interest rate. So it's all about not setting them up for failure. It's really seeing how viable the exit is and how much wherewithal they have. Now, if somebody has a nicer ranch that's going to take longer to move, but it's still within that time, and they have a lot of capital to service and buy or pay down the loan from other sources, that changes things, right? And so it's all case by case in terms of that, just to make sure the exit is viable. But no area is excluded. All of California is available for that product as long as it meets the rest of the guidelines.
And so with that, you're kind of racing against the clock of 12 months. Is that just a regulatory issue that the loans can't go more than 12 months?
Yeah, so we give grace periods, but we don't give extensions because of that. You can't really use that exemption, and then all of a sudden there are lenders that look at it differently. When they try to pay off all the mortgages and become a first, and or they've done things that giving cash out, which is a no-no. And then the other thing they've done is they offer them another extension after the 12 months, which is also a no-no. And we dug into this a lot with California Mortgage Association and some of the attorneys, and we've done it for so long and had so many meetings with the regulatory heads. And so we think we have the understanding correct, but some people do other ways, and I'm not sure. But that's the reason for us.
Okay, great. Let's switch over to the rest of the loans that you do with a line of credit or a standard purchase bridge loan of an investment property. How do you look at geography for those?
Really, it's all of California, but more in the metro markets and things that make sense. As we get into tertiary markets, we become much more conservative for the same reasons that, as you see in the downturn and all of those things, properties can get hit and hammered as they get further and further away from the epicenters of either its job, universities, whatever the driving factors are that make a place and drive the real estate values. So there's less to do about that. And then we look at it as always our worst case scenario. It falls back into our lap. Is it something we want to deal with? Do we want to handle that in those markets? Is it worth it? As you get to outskirt areas, the values generally are not as high, and so it doesn't even meet our minimum loan requirements. It's not worth for us to go in there and get involved. So generally, all of the main metro markets around from up north down to down south, there's no limitations. Generally we see a lot of our loans are clustered either San Diego, all the LA, it could be the Inland Empire, it can go up Central Valley. We don't see a ton for whatever reason in terms of our commercial and various things, but it's not that we're opposed to it. We just don't see a ton of it there. Maybe just our contacts in Southern California that drive a lot of our business. And then obviously Bay Area, where we have been for a long time, was 40 years. So we have a lot of contacts and a lot of that driving this. We do see up north Sacramento and some stuff that gets beyond Sacramento, but not too much beyond Sacramento.
Okay, sounds good. Let's switch gears and talk a little bit about your company and capital. Tell us a little bit about your company's history in private lending and the operation.
Yeah, so since 1986, we've done lending, and we also have an acquisition side of our company. So primarily our lending side, stay focused on that, is been doing regular consumer loans and brokering out like most people did. And we had a small private lending division where we had private individual trustee investors that would fund deals. And we had a guy who managed that and a couple of reps that had contacts. In 2004, we switched over to a fund model, and our first fund was formed, and that grew. And then the 08, 09 hit. Uh, we were fortunate that we had a mindset of long term, and it wasn't without a lot of hard work, but we survived that downturn with keeping our investors' principal completely intact, and the lowest return they got is 7.2, and it went the full 15 years and unwound. So that gave us a lot of credibility for our second fund that started in 2010 because we couldn't put any new capital into our first fund. And that's performed in the same, 7 to 8% consistently. It's grown to about 300 million. At this point, it's kind of hockey sticking as we have more channels. Like I said, or also our product lines are growing, and our contacts have grown in terms of being able to handle larger volume. We're gonna, see that and hopefully continue to grow. We're probably a little over 40 people at Stonecrest. Not all of it's dedicated to the lending side. It's about half and half between lending and acquisition. Probably a little bit more on the lending side, but some employees are shared, like accounting departments and various things that it's hard to really measure there.
And the acquisition side of the business, is that where you guys just buy rental homes and
Yeah, we used to do funds when it was the big downturn, and there was a ton of different opportunities, just closed-end funds that we ran, about 5 of them. But primarily, it's the owner's portfolio that he continues to find distressed real estate and purchase them, and sometimes flip them, sometimes hold them in a rental portfolio, but primarily in residential. And they used to be across the country when we were buying in bulk, but now it's just, in our local markets in California.
and are you looking to grow the fund?
Yeah, absolutely. The fund is definitely poised to grow, and the push is to grow it further and see where we think the model can sustain up to 500 million right now in terms of what we have, and we'll keep evaluating as we grow. But it has been on a growth trajectory. It slowed down for a period of time because we stayed conservative, and our rates all of a sudden didn't look as attractive to private credit that was out there for advisors and investors. But now that's taken a hit, and now we've become the popular guy again, and they tend to fall back on the steady eddy. We just have to be patient during those times. So we probably had about a year and a half of kind of lateral movement where we had constant growth year after year, but I know why, and we just had to ride it out.
Okay. And do you deal directly with investors, or do you only work with investment advisors?
Both, but primarily with investment advisors. We're not seeking to work with individuals, but we just generally get them at our doorstep, referred by other investors who've been with us for several decades, right? So it gets out there, and people refer, or clients leave advisors, and then they become individual investors with us because they one piece that they want to retain is our fund that's been consistent for them for so long.
Great. And you personally have been involved with the California Mortgage Association, which is an association that really serves private lending. And you've been the president of that association in the past. I know you're still involved. What are some of the new things that are going on at CMA, and anything that people need to pay attention to?
EMA is also on a great growth trajectory. I think it's fantastic. We've had a lot of new, uh, both blood and some younger blood, but also new blood, and the membership, which is great. We have shifted in the recent years to really sticking to our core, which was really education, advocacy, driving that really home to not necessarily. There's enough conferences where people are going for the business connections and all the other pieces that people are trying to achieve, and it's a little bit more, I call it glitz and glamour, and what those have. CMA, it's not that it's lacking there, but its fundamentals are really about learning how to do the business properly, finding out what to look out for, being involved in shaping actually our industry, because regulations, especially in California, can probably be the number one thing that could break all our businesses. And we've had to pivot so many times based on different laws that have passed, and paying an advocate there that watches for all of those things and lets us know what's coming down the pipe so we can get ahead of it, I think is invaluable, right? And so the membership is growing. The excitement's growing. We have our conferences are now down to 2, and it's not as difficult. So I think it's a great time for anybody who's looking to do lending in California. I would find it difficult that they wouldn't find value or feel important once they have tried out or seen what CMA is and all the things that they're doing.
Absolutely. And for myself, as not even a loan originator or broker, I do have a broker's license, but my role in the industry is more of a service provider. And I've seen a lot of value from being part of the CMA or being a member of CMA for many years. And it still surprises me about, this dilemma of how, CMA does so much good for our industry and fights all these regulations and there's so many more brokers and lenders in California that are not members and they're not really, all they have to do is join the pay their membership dues, and they're providing essential support. So that still puzzles me, but
It's
hopefully we can.
probably less than a meal they have per month out, right? It's with
Exactly.
a small number to pay for that membership, and the conferences are much better priced. It's for me, I've gained so much. I've gotten so much business out of it. And when I decided to volunteer on the ed committee and then get involved with the board and become the leadership on there, it's paid me back in space. Not the reason why I did it, but just it's been invaluable experience.
Absolutely. Agreed. And it's not all about attending the conference. That's just a nice
of it.
benefit of it. But yeah, hopefully we can continue to try to get more people involved, as even just being a member. And if they can attend the conference at some point, that's super beneficial for them as well. But we'll keep working on it and keep spreading the word as much as we can.
Absolutely. Yeah. Membership has all kinds of other channels, webinars, the website that you helps with us, and you've been involved, and it's been great. I definitely would recommend it to anybody that's looking to do lending in California.
Definitely. And speaking of that, the next CMA conference is coming up in a couple weeks here. It's March 18th to 20th. So look forward to seeing you there in Newport Beach. And I know you're not too far away from my office, and I sometimes bump into you randomly around town. But regardless, I'll always see you at the CMA conferences, and we'll see you in Newport Beach in 2 weeks.
Thank you, Rocky.
Yep. All right. Thanks for your time, Shafiq.
Take care.
Take care.
Bye.
All right. Bye. And that's a wrap for this episode. Stonecrest Financial has been listed on privatelenderlink.com since 2017. I put a link to their profile in the description. You can reach out to them by phone, email form, or a detailed loan request form. When you reach out, please mention that you heard about them from LenderLink and the Private Lending Insights podcast. Thank you for tuning in and listening all the way to the end.